Welcome back to the Wall Street Podcast. We are immediately diving into the definitive analysis on the global battery giant, CATL.
Yes, our focus today is solely on the JPMorgan research report covering contemporary Amperex technology. That's CATL, ticker 300,750. It was published September 26, 2025.
And the headline.
The firm's maintaining an overweight rating. They've set a mid-2026 price target of RMB 480.00.
Okay, so overweight. The report seems pretty clear, though. CATL definitely faced significant headwinds in the first half of 2025.
That's right. They lost market share both in China's EV sector and also in the global ESS markets, that's energy storage systems.
But the core idea, the thesis, it really hinges on two major strategic pivots, doesn't it? Technology and global expansion.
Exactly. JPMorgan expects those shifts to drive them back towards, well, substantial market dominance, possibly starting in 2026.
All right, let's maybe start with those domestic issues first, the headwinds.
Okay. So in the China PV market, and this excludes BYD's own internal supply, CATL's share dropped about 6 percentage points.
6 points. That's quite a dip. What drove that? Just competition.
It wasn't just new players. A really big driver was the surge in sales for lower-end vehicles. You know, those priced between RMB 100,000 and RMB 200,000.
And CATL struggled there.
Well, they were also hitting production limits. Their utilization rate, the UTR, was basically stuck at 90% in the first half of 25.
So they were capacity constrained right when that low-end segment exploded. Makes sense.
Precisely. But interestingly, despite that domestic pressure, they actually gained ground in Europe.
Okay. How much?
Up 3 percentage points. They climbed to 44% market share in Europe in the first half of the year.
Yeah.
And they're holding on to their tech leadership.
That difference is key. It leads us right to their strategy for that low-end segment they were losing in China. How are they tackling that RMB 100K to 200K market if they can't just slash prices?
They're trying to change the model. The chocolate battery swap solution is quite innovative.
Chocolate swap, how does that work?
It lets the buyer cut the initial vehicle cost by up to 30%. Instead of buying the battery outright, you pay a monthly subscription fee.
Shifting the big upfront cost. Smart. Lowers the barrier to entry.
Exactly. They're targeting about 1,000 swap stations by the end of 2025 to support this. Plus, there's the tech angle, too.
Go on.
Their second-gen sodium-ion battery. It's positioned explicitly as a potential replacement for LFP lithium iron phosphate in those entry-level EVs.
Cheaper materials, presumably.
Potentially much more cost-competitive once it scales up, yes.
Okay, so that's the low-end plan. Now let's shift to their tech edge. What's the real impact of this super fast charging capability we hear about?
According to the report, it gives them a solid 1 to 2 year lead over competitors. We're talking about the Shenxing LFP battery.
Launched back in August 23, right? 4C charging rate.
That's the one. We already see it in cars like the Zeekr 001, the Xpeng G6. It allows charging from 10% to 0% state of charge SoC in just 10 minutes.
10 minutes? That's huge for convenience, especially at the higher end.
Absolutely. It's a major differentiator for premium buyers. And that tech edge feeds directly into their global expansion plans.
Right. The bullish 2026 outlook, JPMorgan projects their EU share could climb towards 55%. What specific deals are backing that up?
It really comes down to new OEM collaborations. They're supplying both NCM and LFP batteries for Renault's upcoming A390 and A4 models starting 2025.
Okay, Renault. Anyone else significant?
Yes, the big one is Stellantis, a really deep collaboration there, targeting up to 50 gigawatt hours of capacity by the end of 2026.
50 GWh with Stellantis alone. That's substantial.
It is. These kinds of partnerships are what underpin that projection of getting to 50–55% market share in Europe long term.
So let's bring this down to the ground level. If you're listening to this, maybe thinking about buying an EV, how do these big corporate moves actually affect you?
Well, two main ways. First, government trade-in subsidies up to RM 15,000 in China are kind of pushing the market towards mid to high-end vehicles anyway.
Which plays right into CATL's strengths since they dominate those B and C segments.
Exactly. But second, and maybe more fundamentally, is that battery swap ecosystem.
Yeah.
It changes the ownership equation.
The subscription model.
Right. You might pay, say, RMB 369 to RMB 599 a month for the battery instead of that huge upfront cost. It makes the initial purchase much more accessible.
So looking at the big picture, CATL seems to be addressing the capacity issues. They've engineered this clever shift in the consumer model. They're leveraging tech, locking in global deals. JPMorgan paints a picture of a leader really executing.
The strategies outlined are certainly impressive defenses against the challenges they face.
I suppose the lingering question then, For you, the listener, the long-term observer, is this. Are these sophisticated moves, the swaps, the fast charging, the huge European deals, enough to permanently insulate CATL from the simple, brutal reality of future low-cost competition, especially back home in China? That remains to be seen.